Welcome everybody to this month's live monthly market update. Give me a second as we get rolling. All right. Thank you all for joining. My name is John Pasalis. For those of you who don't know, my team and I help buyers and sellers throughout the Toronto area with their real estate decisions. Once a month, I like to host this monthly update just to talk about the things that we're seeing on the ground. What are the latest trends in the data? And what are we seeing? Kind of anecdotes, our own experience with the people that we're working with, because I think a lot of the times these give us some kind of clues into where the market's heading. We have Davin McMahon from my team who's joining us. And as always, we have David Larock, who's going to be answering our real estate questions. And if you have questions, of course, please post them in the chat. We'll do our best to answer them as we're going and navigating throughout today's session. Perfect. Before we kind of kick it off, I have a ongoing information sessions, about 30 minutes, talks about how to upsize in today's market. It's a bit of a tough time for people who are upsizing because market's very unpredictable. People want to buy first, but then there's a lot of uncertainty when they're selling. Some people get in a bit of a tight bind if they have trouble selling. So I kind of unpacks how to do that, how to decide what to do first, and how to mitigate risk. You can find the link to that in the show notes below. Now, before we kind of kick off with the latest monthly stats, wanted to chat a little bit about something that, of course, has kind of been in the headlines that I've written about and have showed some stats on. And that, of course, is the increase in the number of power of sales that we are seeing in the Toronto area, across the GTA, and, of course, how that is weighing on the market. So, last week or 2 weeks ago, I published a video, wrote a post talking about the increase in delinquency rates at banks. So when we look at delinquencies, this is the number of people who are 90 plus days behind on their mortgage. And RBC published some statistics showing how the number of people 90 days behind has really surged over the past 2 years, from 0.05% to 0.4% of mortgage borrowers, which doesn't sound a lot, but it's actually a relatively high number. And of course, more importantly, beyond the actual number of power of sales, or the more people who are 90 days behind, of course, there are a lot of people who, of course, try to address that, sell their homes on their own. But many of these people, of course, in a bit of financial distress. And eventually, many of them hit the market as power of sales, as the bank takes them over and sells those properties. And of course, these are the arrears in big banks. We're, of course, seeing a much higher rate of arrears in smaller lenders, private lenders in particular. Now, when we look at what types of properties are most impacted, a lot of people would think it's the condo market, a lot of investors, but that is actually not where we're seeing the biggest impact. It's generally in the detached segment, and about 1% of new listings that have hit the market are power of sales. And when we look at the percentage that are condos, it's about just over 0.6% or so of new listings that are condominiums that are power sales. So far more concentrated in the detached market. And again, a lot of that is because those homes are far more expensive, more leverage, and it's that leverage and that debt that's weighing on many of those households. Now, I also published a chart showing where we are seeing them. And we're seeing them mainly in the outskirts of the suburbs. Brock, Ajax, Stouffville had the highest rate, over 1.5% of new listings in those areas were power sale listings. And of course, some of the more affluent suburban areas like Aurora, Markham, were kind of pretty much in the low end. Toronto, close to the middle, just under 1%. So it's not affecting every region the same way. Some areas are far more impacted. Brock in particular, Stouffville, Oshawa, those were those outskirts that really boomed during COVID. And, they're the ones right now, maybe that people probably spent a little bit too much. Prices got a little bit elevated, and they are correcting. And I'm just going to end off by showing a quick chart of areas that saw the biggest decline, that has seen the biggest year-over-year decline in prices. And of course, it's very choppy because we're just dealing with 1 quarter of data. But again, Brock and Stouffville are among the top with, 13, 15% declines year over year in average prices, which is quite big. So as always, I'm going to as I move on to the latest stats, please post your comments. I see a few people have commented, and we'll try to take them. I'll try to cover them as we go through the latest statistics. 1 second. All right. So as we move through the stats, we're going to look at low-rise housing market statistics first. So specifically, detached homes. When we look at the number of sales for detached homes, yeah, we're up about 12, 13% year over year, but we are well below the 10-year average. Just over 2,600 detached homes sold. It's the highest level in 4 years, but for the 3 years, but the previous 3 years have been the lowest level in 20 years. So it's not a very strong volume. We're well below the 10-year average, about 22% below the 10-year average. Again, we're comparing right now sales in September against every previous September going back to the 90s. And, if we ignore the previous 3 years, we're still pretty much at the lowest level in 20 years or so. So, of course, the previous 3 years were a little bit lower. So we're improving, but we're still quite soft when we think about kind of the volume of detached sales. Now, new listings, interestingly, for detached homes are actually the highest level they've been at ever on record, going back to 1996 for the month of September. We had just over 9,000 new listings of detached homes, and we haven't hit any volume that has been higher than that. Again, I think a lot of this there's a couple of factors going on right now. Number one is new listings counts every time a property is listed for sale, which means the same property can be counted more than one time if it's constantly relisted. And we are seeing a little bit of that. But I suspect that is not the main trend. Of course, the main trends is what we talked about earlier: far more distress, far more people in a power of sale position, but not just people in a power of sale position. People that may be in a power of sale position are trying to exit and sell their homes before the bank takes them over, because they don't want to be forced out of their home. Most of these households, believe it or not, despite being in a power of sale position, actually have equity in their homes. I spoke with a lot of bankers over the past month, and the story they tell me is consistent, that most people, this is not like the US subprime crisis where no one has any equity. Most of these owners have equity in their home. The reason they're being forced out is that they just can't make their payments. Payments went up, they've lost their job, or whatever the situation is, they can't make their payments. So, many of these owners, of course, would rather try to sell under their own terms and move out rather than being forced out by the bank. And of course, I think this is contributing to the increase in new listings that we've been seeing recently. And then, of course, more importantly, when we look at active listings, and this is I'd say a better measure than new listings, because it tells you what is available for sale. It's, one listing per property at the end of the month. And we're still at the highest volume, not the highest volume on record. There were more active listings back in 2006, 2008, but we're still quite high, just under 14,000 detached homes for sale. So relatively high volume. And of course, when we combine a lot of listings and soft sales, this, of course, is pushing up the months of inventory for detached homes. Months of inventory being just the number of active listings divided by the number of sales in the given month. And we've hit 5, which is relatively high for the Toronto area. Vancouver, for example, is normally quite a bit higher than Toronto, but for Toronto, that is a relatively high volume when we think about months of inventory. And when we look at prices, this is putting downward pressure on low-rise home prices. Prices for low-rise homes, about 1.25 million, down 5% year over year. And the distribution of this decline does vary. We got to keep in mind 5% is just an average. Some regions are closer to 10%, some are 2%. So there are quite a few differences when we look at how the market's responding. But generally, I would say, low-rise homes are down across the board. It's just a matter of how much they're down, and that really depends on the type of home and the area that the property is in. So that's a little bit about the low-rise market. Going to chat quickly about the condo market. Somewhat similar trends. Sales just over 1,400 sales. So again, sales are up a little bit over the past few years, but well below the 10-year average, about 25% below the 10-year average, which is around 2,000 sales. We're at 1,400, so relatively soft volume still. But when it comes to new listings, strong new listings, 5,200, not the highest on record, but pretty close. Last year was a little bit higher, and then peak COVID 2020, when everyone's leaving downtown, was even higher. But again, relatively high volume. But more importantly, active listings are the highest on record for condominiums right now. We have over 9,000 condos available for sale. And again, in a relatively soft market where demand is weak. And of course, this is keeping months of inventory for condominiums relatively elevated at about 7 months of inventory. And prices as well have been trending down over the past year and a bit, with prices down 4% at $676 for condominiums. So on that, I'll wrap up the stats part. We'll bring in Davin from our office. And maybe actually, before we do that, maybe we chat about a couple of the questions we got. What do you think?
Yeah, absolutely. So the first question here we have from Iman. It says, I would like to buy a 1+1 2-bath, roughly 700, 800 square foot condo in Richmond Hill. Do you think I should do it now or next year? Hard to tell where the bottom is. We were talking about this in general, trying to catch the bottom the last couple weeks. So maybe you can just comment in that regard.
Yeah, I think you need to be super cautious. I mean, here's my advice to people generally. I think what you want to do as a consumer, as a buyer, is be active in the market. You don't necessarily have to buy, but this idea that we can sit back, wait for the bottom to hit, and then we'll jump in once the bottom hits is unrealistic. By the time we've hit the bottom and people jump in, you're well past the bottom. You know what I mean? So, the best move a lot of times is to keep an eye on the market. And there are different approaches to take right now, right? And there's no correct approach. There are some buyers, and I did a video on this like maybe a few weeks ago, some sellers who are selling at very low prices. So, and when I mean low, I don't mean 5% down. I mean, I'm seeing condos selling for 20% below what comparables sold for a year ago, right? For whatever reason, these people are distressed. They need to move on. They need to sell. So if you're getting a 20% discount, are you overpaying in today's market? I would say arguably probably not. You're already pricing in a discount because, again, this has not been reflected in average prices in the GTA or in the building because these are the outliers. Most people aren't paying attention to them yet, right? So even if the market does come down that much to what you've paid, you've already kind of priced that in. So, this is one strategy some buyers are taking, knowing full well, maybe they didn't time the bottom, but at least they're getting a significant discount to what comparables are selling for, right? The other strategy, of course, is just to keep an eye on the market, stay somewhat active, and based on sort of the dynamics and the trends of the market, you can decide when to jump in. And when you're active and you're looking, you start to see when the market is slowly starting to rebound or at least plateau. And maybe that gives you a little bit more confidence to jump in. Now, I will say there's always going to be some uncertainty, right? Because, I mean, from my experience, every time we've had a slowdown, the minute the market starts to recover, everyone starts screaming, don't do it, don't jump in. It's what do they call it? A dead cat bounce. It's going to go further. So, and you don't know what's going to happen. So there's always going to be some uncertainty. I think you just have to decide what level of uncertainty and risk you're comfortable with. But I don't think there's a rush to buy now. Like, I think there is still probably some downward pressure on the market. I mean, Royal LePage, I should have posted this earlier in the introductory because I thought it was fascinating. Royal LePage came up with a report, I think yesterday, talking about how prices will likely trend down for the rest of the year leading into the new year. I don't think I've ever seen Royal LePage or Remax or any of the big real estate brokerages talk about prices trending down. So we're in a slow market. So again, I think my best advice to people is you should get active. Like, you should be getting listings. You should be kind of working with an agent, even if you're not going to buy for a year, because you just get a better sense of the market dynamics and the amount of traffic a property's getting and the number of offers, how quickly they're selling, and all of that stuff. So you're more informed when you decide to jump in.
Yeah. Yeah. I mean, you said it. There's really nothing in the cards that would indicate things would be spiking up in any kind of short term or even medium term. So yeah, this person's probably safe to, like you said, sort of monitor the market, take things slow, and operate with you have some choice out there. So
yeah.
Next question we do is from Raghu. It's a very specific question. I would probably implore this person to reach out to you, John, John at realosophy.com, because that is a very specific question about a very specific house in a very specific spot.
Let's give it a shot anyway.
Even
if we don't give a specific answer.
Sure. Okay, sure. So from Raghu, my parents in their 70s need to sell their 2-story detached 2,400 square foot, 40 by 100 lot, 1980s house. This house is located in Highland Creek, Scarborough. They would like a relatively quick sale. What is the pricing strategy that you recommend? The 2022 peak was probably 1.5 million. And it sounds like that's probably not when they bought it. He just staking that claim.
Yeah.
So, yeah.
So the question here is more about pricing strategy, which is how to price your home. And actually, this is a good, this will be a good segue into our chat because I wanted to chat about pricing strategy. But so the idea with pricing strategy is, do you price it low, expect multiple offers and sell for over asking, or do you just price for what you want, close to what it's worth, and wait? And that's, that area of the city, generally, I would say you take the latter approach, right? You list for what you want or close to what you want or at the high end of what you want, and you wait. There are still, interestingly enough, and I didn't post in the stats, roughly a third of homes in the city of Toronto are selling for over asking right now. Okay. But I would say that this is a very, very misleading indicator of the market, because I have so many people who are coming up to me like, oh, so-and-so sold for way over asking, this sold for over asking, and even real estate agents. I've heard real estate agents who are, listing homes in my area who I talk to, like, oh, I see all the homes selling for over asking. We're going to price low and it's going to be, got tons of offers.
Yeah.
But that's not really what's happening. What's actually happening with many of these. Listen, if you have a $1.5 million home and you list it for $999, yeah, you're probably going to sell for over asking. It doesn't mean you're going to get what you want. Yeah. And many of these homes are not getting really what I think they should be getting. They're kind of getting at the low end of value. Now, there are maybe 10%, maybe 15% of homes, I don't know what you think, Davin, like in the GTA, that are the outliers, that are unique homes. Like, I have clients who live in Bloor West who are looking to upsize in Bloor West, and the few homes they've looked at all got like 7 offers and 8 offers, like serious buyers, not selling for cheap prices, like selling for decent prices, not crazy premiums. But again, those were unique homes that a lot of people in the area also want to upsize to, right? So unless you're that property and unless you're in an area that has that high demand, you generally don't want to list low. You want to list at the higher end and wait. And knowing, and this is the challenge, to the question, I'm going to come full circle. I think it said something like, we want a quick sale. Yeah. The problem with that is that if you want a quick sale, then you're not maximizing your price in today's market, right? So if you do want to unload it, okay, yeah, maybe you price low and you do the offer date thing, but knowing full well you're not necessarily maximizing your price, because everyone who's showing up on that offer night wants a deal. They're not, it's not the same mindset of buyers who are rushing in on offer nights, willing to pay anything to get a particular home. Everyone who's shown up on that offer night when you're priced at $999, want like 2/3 of them are going to be at $999 or under, right? So yeah, that's the tricky part. Getting a quick sale in a very slow market is hard. You generally have to sell or price a little bit below what it's worth, quite honestly, right? So whether you do the offer night and just sell for less than market value, or just price it for less than market value, those are the kind of the only approaches to sell quickly in a soft market, because that part of Scarborough is generally a little bit slower right now.
Yeah. Like what you're saying to Iman for building in a discount, for him or her, I'm not sure actually, for them to, build in something 20% less, they would be doing that, on their offer sheet. Whereas in Ragu's instance for the parents, they'd be building in that small discount on their listing price.
Yeah.
And the savvy buyer and savvy buyer agent in the area would know that, okay, this is a good deal for this house. And you may actually achieve that quick sale.
Yeah.
So I'd have to agree that's probably the way to go.
Yeah, absolutely. So Davin, what else have you been seeing kind of on the ground over the past little while?
Well, like you were saying, the Bloor West Village offers, things like that. Like people they're aiming for like the very specific house.
Mm-hmm.
They're not just kind of taking any old thing. So I feel like, the folks who are out there buying, they're sort of buying when everything sort of lines up. In the past, 2021, 22, even 2020, even, before that, the fervor was to just get in the market and put all the pieces around that, right? Mm-hmm. Schools, commute, whatever it may be. Now it's, okay, does this house satisfy the school? Does it satisfy my commute? Does it satisfy the things I want to do with my life? And they're sort of buying that way. So being, extra defensive in their buying, and very thoughtful in their buying, and not really rushing. And what that can do is it can actually push good prices for the homes that do satisfy all of those boxes. Mm-hmm. And those ones will, like you said, sell well. And then to speak to your, the things selling over list, everyone tries to mimic that, and they maybe aren't so successful. So, what were you meaning by that? You wanted to unpack why it works, but it doesn't really work.
Yeah, it doesn't necessarily work. Like I said, I mean, what I'm finding is some of the homes that are selling on offer nights that are not what I would say the top 10%, are selling in the low end of the value range, right? If we think about the value range being, if the home's worth $1 million, it's not really worth $1 million. It's really worth either, between 975 to 1.25, say, or $1,025,000, I should say. And many are selling at the low end of the range, even though they have multiple offers, because buyers are being extremely conservative. When the seller says, do you have much to improve? A lot of buyers are like, no, I actually don't. Or, you know what, forget it, I changed my mind. You're trying to squeeze money out of us, and just walk away. So there isn't this urgency and frenzy on offer nights. Some have conditions, some are, many are not being aggressive. And I'm even seeing it some on bully offers or preemptive offers. And these are homes that have an offer night, but sell, 2-3 days later because someone comes in with a bully offer. And what I'm finding is that some of these homes aren't selling for crazy prices, and I think what's happened is the seller listed for the offer night, they're 3 days in, only have 4 showings booked or 5 showings booked because it's a slow market, that's kind of normal. And they just get anxious. So they just take whatever offer shows up. And again, I think I mentioned, I can't remember, maybe on our round table with Steve, that I don't think that's the better strategy. Like, your better strategy for most homes is you kind of price at the high end, and listen, you may have to reduce a little bit. Like, maybe the price that you get is the low end of value range, but in some cases you get the high end, because if it happens to hit a lot of the check boxes for a particular buyer, then you luck out, right? And we've had this with, some of our listings where that has happened. So you need to be, you want to try for the highest, and then if you settle for a little bit lower, that's fine. But you want to try for the max you can get.
Yeah, and what you don't see in the sort of most of the data, unless you're really digging in on Broker Bay, which is our booking software, some of these places that they are selling an offer night, but with a single offer,
Yeah.
right? And it becomes a one-to-one negotiation on what the buyer and the seller may agree to what the value is, and you have to wonder how many of those are actually taking place on those sort of lower value range sales. Because I've seen some in Plater Estates, on the west side of Broadview, which is kind of Plater Estates light, but still.
Yeah.
That's Jackman, good sale prices. In Riverdale, I saw a conditional bully offer get accepted. You never
Conditional
saw that.
bully.
Yeah, it was 24 hours, only 24 hours. Maybe they snuck in for an inspection. I'm not sure. But yeah, things
I mean,
like that.
for those of you, who don't, I mean, a preemptive or a bully offer is typically unconditional, right?
Yeah,
No conditions. This is firm. It's way over asking. So it's extremely odd for someone to take an offer with conditions before their offer date. But again, I think this speaks to how slow the market actually really is. The seller lists, they think the market's booming because they saw another 3-home sell for over asking. And this is the thing we talk about, I mean, in our meetings with our agents, like before we're going to, and you have to be, it's very regional. So before you list in a given neighborhood, if 5 homes sold for over asking, what a good listing agent should be doing is calling every single one of those agents and saying, how are your showings? How many showings did you get? How many offers did you get? Because you're going to get different signals in different areas. If everyone says, oh my God, we only had 7 viewings and 1 offer, and we got so lucky because they really liked the home and paid for over asking, that's very different from saying we got 30 viewings and 8 offers, right? So, and again, it's not just the geography, it is the type of home. So you need to kind of understand where your home fits in sort of the broader market and what's going on in your region to determine what your pricing strategy is. Because just seeing that home sell for over asking, you're right, is misleading. They could have just 1 offer. And that generally is what's happening right now, I find.
yeah. And there's not a lot to choose from in terms of quality listings. Talking to neighbors, friends, everybody. Moving house is expensive.
Yeah.
Life in general has become very expensive. And, to move is now, it's not really a luxury to be like, we're moving house because we just want more space. It's more of a, it's born from necessity. It's like, okay, we need more space and we're going to move. And that's just, kind of slowed everything down. When houses don't become available for sale, obviously people don't have the opportunity to buy them and vice versa. So
yeah,
it's just kind of slowing it all down a bit.
And one thing I was also thinking about when we were chatting about this before the show is, sometimes we see things and we don't know if it's the broader market or if it's a trend. I mean, one thing we talked about is like, I feel like many of us had so many listings, all of a sudden everything's selling. Like, I don't know, we sold like 5 or something, 4, in the past, like
scads of listings, and they're mostly all gone.
Yeah, exactly. And in the past, you never have listings that sell in a week. Now they accumulate, and all of a sudden everything's selling. So, I mean, literally just before our recording here, I'm on our, looking at writing some code and looking at some stats. I'm like, are sales up? Like, are sales actually up the first 2 weeks of October? Like, a lot of our stuff sold. Like, is this just a slight rebound? And it's not. Like, it's, they're isolated. I mean, we just happen to sell a lot of our listings, but sales are actually not up. They're actually down a little bit year over year. First 2 weeks of October, which I also thought was kind of interesting given that we've been on this slight upward trend. So
the ones that are left, they're still getting traffic. What was quiet early September is, waking up a little bit late September, early mid October. Has it translated into offers and sales yet on those? No, but I guess some traffic is a decent indicator, but nonetheless, slow. But I think just people are being methodical.
Yeah, they are. And listen, I think a lot of times, a lot of sellers in this market are, I think, struggling to adjust. They're listing homes for sale and they're getting no showings. Like, especially if you're a fixer upper. I was out earlier this morning just meeting with a friend and bumped into somebody and they're talking about this, that, they have a family home, it's a fixer upper, and they got like 0 showings. And this is the market we're in, especially if you are one of these homes that's a fixer upper, needs a lot of work, a bungalow. Like, there's just not a ton of people looking for those types of homes, like outside of core areas that are kind of close to downtown. If you're like in the inner suburbs of Toronto or even further, it's a sluggish market for that. So I think people just need to adjust to kind of a slower market.
Yeah, I think it was Gus or Anastasia in our weekly meeting talking about the young guest buyers. Like they don't want to have a fixer-upper home.
Mm-hmm.
They just don't. I'm sure they're working, long hours, stressful stuff. To come home to a home that needs another 3 hours of work every night just seems very daunting. So
Yeah,
I don't
and
want
not
to paint it
everyone,
with the same brush, but yeah, I would agree with that.
and not everyone can afford it, especially with
Yeah.
prices are still elevated for a lot of people. Between your down payment, if you're doing a reno, well, you need another $150,000 to do reno, which is not always available to everybody. And I think that's why many of these fixer uppers are a little sluggish. Again, outside in some of the premium areas, like the clients I'm looking in Bloor West are looking at fixer uppers because, I mean, interestingly enough, my client was telling me all of his neighbors are in his shoes where they have a nice home, but they want to upsize to something nicer. So they're all looking for kind of fixer uppers that they can renovate and rebuild into a bigger home. But again, this is a very specific market, specific type of product in a specific area. It's not a general trend. Awesome. Davin, anything else before we kind of bring on Mr. Larock?
The next question there really looks like a David question. So that's probably
awesome.
Yeah, that's definitely a David question.
Beautiful. Awesome. Davin, thank you again for the chat. We'll bring on David.
Cheers. See you.
All right. Mr. Larock, how are you?
I'm good. How are you?
Fantastic. Thank you for joining us as always.
It was a pleasure.
Yeah. So I wanted to kind of kick off today's chat. You wrote a post maybe 2 or 3 weeks ago, I can't remember, which I thought was super interesting, where you were talking about the US Fed's policy and strategy and the fact that they have a dual mandate in the US, targeting inflation and maintaining a certain level of employment. And what was interesting about your post was that you mentioned that those two goals have conflicting policy responses. And can you unpack that and what you mean by that? Because I think it is interesting. And then, of course, like once we're done that, we got to think about like why what's going on in the U.S. Fed, of course, impacts Canada still. But more importantly, let's just talk about the conflicting kind of policy challenge that the U.S. Fed has.
Sure. Well, as Pierre Elliott Trudeau once said, the U.S. economy is an elephant, and when you're sleeping next to an elephant, you feel every grunt and groan. Something like that. I probably butchered the quote. But the reality is, yes, we have to pay close attention to what happens in the U.S. and the movement of U.S. Treasury yields. There's a gravitational pull that affects our government of Canada bond yields and by association, our fixed mortgage rates. Back to your question, the Bank of Canada has a singular mandate. They have to promote price stability, and that is basically defined as keeping inflation at 2%. Inflation is tracked through a series of gauges, but it's pretty straightforward. When inflation's too high, the Bank of Canada needs to raise its policy rate to reduce demand and help cool inflation. And if inflation gets too low, then they need to lower their policy rate to stimulate demand. In the US, the Fed has a dual mandate. They have to do the same thing. They have to preserve price stability, but they also need to promote maximum employment. That is their secondary mandate. And the mandates are equal. In other words, they're supposed to, a bit like a mom or a dad having two kids, they're supposed to care as much about one as the other. The challenge today is U.S. inflation is too high. It's headed north again, and it's at 3%. It never got near 2%. And with pressure from tariffs and a lot of profligate government spending, the bond market is concerned that inflation in the U.S. isn't under control and is headed in the wrong direction. So that will put pressure on the Fed to tighten monetary policy, or at least to refrain from loosening it. Because if the Fed is cutting and the bond market is worried about inflation pressure, however the Fed tries to help the economy by cutting its policy rate could be undone if U.S. bond yields go the other way, because the borrowing rates in the U.S. are based much more on U.S. Treasury yields. I'm calling that bond yields. In the U.S., they're called Treasury yields. It's the same thing. there's more borrowing in the U.S. that happens on U.S. Treasury yields than directly than rates that are directly tied to the Fed's policy rate. So if the Fed does something the bond market doesn't like, it may end up shooting itself in the foot because it'll lower short-term rates, but the bond market investors will pull up longer-term rates. The
Okay, so
reason the Fed wants to cut is because it's worried about the job market. It thinks
yes.
that employment is weak, part of that dual mandate, keep prices stable, also promote maximum employment. The flip side is there's weakness coming out of the U.S. economy right now, showing in the jobs data. Again, U.S. government's in a shutdown. We're not getting current jobs data. But yesterday, Fed Chair Powell, U.S. Federal Reserve Chair Powell, said he was increasingly concerned about employment and less concerned about inflation. And the market is now pricing in a 97% probability that the Fed cuts at its next meeting at the end of this month.
At the end of this month.
Yeah.
Okay. Now, maybe unpack, you touched on, potentially longer term yields rising. So why would that happen? And maybe could just unpack for everybody why that might happen in the face of potential, like you said, even if the Fed cuts and longer term yields increase, under what circumstances or scenarios would longer term yields increase? Maybe just kind of unpack that for everyone.
Sure. So if you have a variable rate in the U.S. and the Fed cuts, your rate drops by the same amount as the Fed reduced its policy rate. So a quarter point cut in the Fed's policy rate leads to a quarter point reduction in U.S. variable mortgage rates, same as in Canada.
Mm-hmm.
But U.S. Treasury yields are determined every day by thousands of investors, including massive financial institutions, pension funds, life insurance cos. They're all buying and selling yields based on whether they think they're too high or too low. So if something comes out, let's say you work for a life insurance company, your job is making sure that you have enough coming in. You've invested the life insurance companies, very simple analogy. You've invested the life insurance assets, that the money that you control for all these life insurance policies that the cash is coming in on, so that you have enough coming back in the future to honor those policies. And you now see the Fed's cutting, and we think that's wrong. We think there's too much inflation. Lower short-term policy rates by the Fed are going to drive inflation higher. That inflation is going to eat into the return that I'm getting on my bond yields, on my treasury yields. So how do I react to that? Well, I need to sell my treasury yields and find something that pays a higher return. And in the act of selling those yields, if you and me and lots of other people, if more people are selling than buying, then in order for there to be a market, an equal market of buyers and sellers, the yields have to go higher in order to clear. And basically what investors are saying is, if there's more inflation, that's going to erode the return I'm going to make on my investment, and I need to recalibrate. And if that means I need to sell bond yields at their current price, then I'll do that, and I'll invest the money elsewhere to protect my return better. And if enough people do that and yields go higher, two things happen. Number one, the original return is restored because now yields have moved higher. So yes, there'll be more inflation, but yields are now higher. So my return is now attractive again relative to where it was before yields went higher. And number two, borrowing rates that are based on those yields also go higher. And that means people have to pay more to borrow. And when people have to pay more to borrow, they have less money to spend on other things. That reduces demand in the economy. That slows the economy. That is a headwind, and it has a negative effect on economic activity. So it started, again, going back to the beginning, the Fed cut its policy rate because it was worried about weakening jobs. It did that. It cut the policy rate because by creating a lower short-term rate, it was trying to increase liquidity in the system, make short-term borrowing cheaper, and to drive economic activity. But the reaction in the bond market was to say, we don't agree with that. We don't have any dual mandate. Quite frankly, I'm an investor for a life insurance company. I don't care what employment in the U.S. is and whether or not you're cutting rates to help people because there's not enough job creation in the economy. I got to preserve my return, and I think there's too much inflation, and your cutting rates is going to drive more of it. So I'm now going to reprice bond yields to protect my return. I'm just doing my job, and in doing that, I'm raising the cost of long-term borrowing rates. Which, if you think about it, if 10 people borrow at the long end of the yield curve, and two people borrow at the short end of the yield curve, the rate cut by the Fed helps two people. Bond yields headed higher at the long end of the curve makes borrowing more expensive for 10 people. The Fed thought that it was helping the economy. That was its intention. But in the end, it shot itself in the foot because it actually made borrowing expensive for more people than it helped. Now, in the Fed's case, they can't really control what the long end of the bond yield curve does. They can certainly say, we're not so worried about inflation. We think it'll be okay. They can use soothing words. They can try to persuade the market that their assessment is correct. But the market doesn't always buy it. And ultimately, that's the conundrum the Fed finds itself in, because they've got to worry about inflation pressure, which has the market concerned, and a weakening job market, which calls for looser monetary policy and cuts, whereas higher inflation calls for tighter monetary policy, and if not rate increases, certainly no more cuts.
David, that was super helpful. I hope all of our viewers found it helpful. I mean, one of the things I want to try to do on these segments is unpack a lot of these ideas, for everyone who isn't a bond trader and a macro analyst, what all of these things mean and how they flow through to the economy and our housing market. And on that note, kind of next question, of course, is, well, okay, if that happens in the US, bond yields go up, people think inflation's an issue, how does that flow through to Canada?
Well, as I said in the beginning, the US economy is the elephant. We're the mouse. So ultimately, if US bond yields move higher, then that will put upward pressure on government of Canada bond yields. We've seen that lots of times. In fact, if the US, let me give you an example. If the US were to have a lousy jobs report, and U.S. bond yields went lower because the initial reaction was to say lousy jobs means the economy is going to slow, and assuming that there wasn't also concern about inflation pressure, in a vacuum, U.S. Treasury yields would fall. On that same day, there have been examples where we get a really strong employment report, and that suggests all the opposite things, that our economy is stronger than expected, that the Bank of Canada is not going to cut rates, maybe the Bank of Canada will raise rates. You would think our jobs data, again, in a vacuum, would, if it was really strong, would cause our bond yields to go higher. But if we get a strong data point and the US gets a weak one, we fall as if our data points were weak as well, because the gravitational pull of US Treasuries is so strong that really their news has more impact on our bond yields than our news does. And I've warned people about this for some time. If the U.S. has, and the U.S. has much more of an inflation issue right now than Canada does, in part because their federal government is deficit spending much more aggressively than our federal government. The reality is, if the U.S. Inflation problem persists, it will push Canadian rates higher, regardless of what happens in Canada, or if not regardless, it will be more impactful on the direction of our rates than whatever is happening on the domestic front. And that's why we pay close attention to it, because those grunts and groans really have an impact.
Yeah. And so, I mean, for everyone watching, of course, it's an issue, because if Government of Canada bond yields follow the way David's saying they might, this, of course, puts upward pressure on 5-year or longer term fixed mortgage rates. And, I've been speaking at a few events recently, a couple of conferences and dinners with bankers, and this seems to be the biggest concern most people have. Like, what's going to happen with bond yields and in turn, of course, longer term rates, because it impacts everybody, and it especially impacts, builders who are financing projects. An extra 50 basis points or even 100 basis points is a huge factor, obviously impacting their financing. So thanks for that, David. What other kind of key things are you looking at with respect to the Bank of Canada next moves, outlook on, potential rate cuts, what the market's thinking?
I think the next big thing that we're going to be talking about as it impacts mortgage rates and bond yields is the federal budget, which is coming out soon. When you think about the Bank of Canada and the pushes and pulls that it has to manage right now, inflation is pretty much under control, and the bank is probably leaning towards more cutting. Its policy rate's at 2.5. It won't be providing stimulus for our economy until they get it down around 2%. If the federal government, so right now, our economy is still chugging along a little bit better than most economists think. They forecast that it'll be lower. They're pleasantly surprised when the data come out. And so far, we're seeing the negative impacts from tariffs limited to certain industries like steel and automotive.
Mm-hmm.
The Bank of Canada is worried about a knock-on effect. In other words, they're worried about economic slowness spreading throughout the economy from these most impacted areas. But if in the federal budget there are really targeted programs designed to help the sectors that are being hammered by the tariffs, maybe the Bank of Canada looks at that and says two things. Number one, we don't have to be as concerned about contagion because the federal government is being aggressive about helping the sectors that are most negatively impacted. So that makes them less concerned about having to cut to provide stimulus to offset the headwinds from tariffs. And number two, if the federal government's going to be aggressive in their spending, then that will add inflation pressure, and the bank would be more concerned. They'd be less concerned about weakness because of the targeted stimulus going to the sectors negatively affected, and they'd be more concerned about inflation risks because if the government is going to increase spending, then that's going to add inflation pressure, and the BOC just kind of is just getting to the point where it was saying inflation's, back near target. We're not as concerned. They have a little bit more room to work with. But that is the X factor right now, is what will that federal budget look like? It's also Prime Minister Carney's first budget. He's a former central banker, so he'll know exactly what the pushes and pulls of the Bank of Canada will look like. But he's in politics now, different game. And ultimately, I think that's the key. I think when the federal budget comes out, that will be the next major that will be the next key new piece to factor into forecasts. My instinct is it will probably be more responsible than the liberal budgets we've seen from past governments. And ultimately, I think my bet is that it will keep the bank on a dovish footing and probably allow for more rate cuts in future. But again, we'll know when we see it.
Awesome, David. Thank you so much. We're going to turn to the questions. I don't know if Davin's still on. If not, I can take a look at them. We have one question here from, I hope I'm pronouncing this right, Lavar, who said the OSFI loan to income program that was implemented at the beginning of the year is capping buyers' purchasing power. It diminishes the impact of lower interest rates. What are your thoughts on that? And has it been implemented yet?
Yeah, so
maybe unpack what they're talking about for the people who don't know.
Yeah. So when COVID hit and rates were below 2%, our regulator did a very smart thing. They put in place a stress test, which ensured that even though people were borrowing at very low rates, that they could afford higher rates when they came. And thank goodness for that, because rates are higher now. And if everybody who borrowed at 2% could only afford a rate at 2%, now that rates are at 4%, all of those borrowers would be getting hammered at renewal, and we'd be facing much more strain on our real estate markets. And if you remember what happened in the US in 2008, that was a big factor. We learned from that, and we implemented the stress test. The regulator over the years has looked at it and said, what do we have? The stress test did its job, but is there a better system in place? And a lot of folks think the stress test will actually be phased out. And in its place comes this thing called LTI, which is loan to income. And basically what it says is we are going to cap the amount of loans a lender can make where the loan to income ratio is over 4.5 times, because all of our data and analysis of default risk says that when a lender lends somebody money that is provides them with a loan that is more that the cost to service the loan is more than 4.5 times their family income, that those loans are most vulnerable. So lender, you can make those loans, but you can only make them 20% of the time. And when you get over 20%, you have to stop making those types of loans. And that way your portfolio will never be overweight those most vulnerable borrowers. But the LTI at 4% isn't really a factor. Rates have to go lower for the loan to income to really be a limiting factor. In other words, at 4% right now, with the total debt service and gross debt service ratios where they are, LTI isn't a factor. You can get 4.5 times based on the ratios that are allowed by the regulator separately. By the way, the reason why this LTI came out is lenders were being given some discretion about lending over the maximum GDS and TDS ratios, the 39, 44, or basically a 44% TDS. And they were being given discretion to lend over those amounts, and they were doing it a lot. And basically what the and it was more the banks than the monoline lenders, because the monoline lenders were limited by the default insurers, who also have a say in how they lend. But the banks have a lot more leeway, and the LTI was basically saying, if you want to make these exceptions, because sometimes borrowers have a lot of assets, or sometimes there's something about the file that mitigates the fact that the income ratios are too high. And in those cases, they're saying you can make those exceptions, but you have to cap them at 20% of the business that you're doing, so that this doesn't go too far. And again, that LTI exception isn't really a factor when rates are 4%. So I don't think it's true that right now LTI is an issue. I think it is a future cap. It's better designed, and ultimately I think it'll eliminate the stress test. And when individuals no longer have to qualify under the stress test, everybody's affordability goes up by 20% overnight, and then it's up to lenders to decide who they want to lend to with higher exposure versus lower exposure. But it takes it out of the individual. It's no longer an individual constraint. It's a portfolio constraint that lenders have. And that's probably beneficial for individual borrowers, certainly strong individual borrowers who lenders want to lend to. Sorry for the technical explanation, John, but sometimes there's no other option.
I appreciate it. Next question. Kevin said, I recall the Bank of Canada very recently providing rate decision explanation that gave the impression that the Bank of Canada thinks it has a dual mandate more than the US Feds. I'm not sure if you're familiar with what Kevin's referring to.
Yeah.
Okay.
Okay. So the Bank of Canada will sometimes confuse people because it'll talk about weakness in the economy or employment, even though technically its mandate is only to manage inflation. But what the Bank of Canada would say is, even though we don't have a direct mandate to manage the economy or weakness in employment, the bank is charged with caring just as much about below target inflation as it is above target inflation. And if there's weakness in the economy, or if jobs get pounded, that would create below target inflation and potentially even deflation. So when the bank talks about weakness in the economy, it all ties back to its inflation mandate, even though it sounds when they say it like they do directly care about weakness in the economy and about labor. What they really care is about how those things impact inflation. And since they do impact inflation, citing them as concerns is consistent with that single mandate.
That's very helpful. Thank you, David. And our last question before we wrap up is from Chris, who said, if there was a good chance the US Fed will cut the rate on October 29th, what are the odds the BOC will also cut the overnight lending rate?
Well, right now the gap in the rates is quite wide. So the BOC has cut much more than the Fed. I don't think the Fed cutting or not cutting on October 29th has a huge impact, because ultimately the Fed's policy rate is much higher than the BOC's policy rate. And yeah, I think ultimately if the Fed cuts and the BOC doesn't, that probably bumps the loonie a little bit higher. It has some impacts, but I certainly don't think it's a case where we have to do what they do, or what they do automatically changes the Bank of Canada's plan. We've done more cutting than they have. Our economy has less inflation. We are thus far showing more impact from tariffs. So different game here at home.
Awesome. Thank you, David. And thank you all for your questions and for joining us once again for our live monthly market updates. We will see you again next month.